Alrighty, folks, this is a series that more and more people are coming to watch and hungry for. We've got Mr. Dan Bird to talk about what's going on in the stock market. We've obviously kind of held kind of a sideways week, kind of in my opinion, but got to hear what Mr. Dan Bird is seeing in the charts, what's going on in the stock market. How you doing, man?
Good. Some people might take issue with a sideways week.
Yeah, I don't know. I'm not really a stock guy. That's why I wait to Sunday to figure out what happened on during the week.
Right. Yeah. It was kind of a down week.
Oh, darn it. Down week. All right.
But that's okay. Last week when we talked, I said it would be healthy for the market to pull back to 4,300,
I remember.
all that. So the market has pulled back, not quite yet to 4,300, 43.48. So it's got 48 more points to go. But yeah, let me share and I'll show you what I'm talking about.
Okay.
Before I do this, let me show my newsletter real quick. So if anyone's interested in getting the newsletter, just send me an email to breakpointtrading@gmail.com and I'll send you last week's and add you to the list this week. These are two of the cartoons from last week.
Mm-hmm.
The market was roaring higher, and then all of a sudden last week just had a big drop.
And are we going to talk about what may have transpired to have that? I don't remember any big economic news. Was this just the market realizing that the Fed is serious?
Well, it depends on who you listen to.
Okay.
If you read the news, they're all saying, well, the Fed now is saying they're going to raise some more. I don't necessarily believe that.
Oh,
If they do, the best chance that they will have to do that will be in August.
Oh, yeah, right. The base effect is zero.
Yeah, when it looks, actually it's less than zero.
Oh, it is. Okay.
That it was actually lower. Yeah.
Oh, wow.
A year ago. So in August, it might appear that inflation is starting to tick back up. But in July, it's going to look like it's continuing to drop off a cliff. We might hit 3% even in July.
Yeah,
but
I put out 2.9. I'm just going to call it now 2.9 CPI headline.
Yeah, could be less than 3. Could be that 2 handle that the Fed's looking for.
Yeah, exactly.
So I mean that will be good for them, but they still will talk about we're not going to pause. That's the mistake that was made in the 70s. That's why Volcker had to come in and crank up rates to kill inflation, and we don't want to make the same mistake. So we're going to keep the pressure on until we're sure that it's down. That's what they'll talk about.
Okay.
And they talked about that last week a little bit. So a lot of the news has said that's the reason that the market is selling off, but that's not the reason that I gave last week.
Right.
The reason I gave was we had options expiration. We had triple witching the previous Friday.
You did. You said the first couple of days would be follow through, and you were right.
Right, which is this candle right here. This red one right here was Friday. Normally, the first couple of days before options expiration, the market does the opposite of whatever it was doing. So it was going up, so the opposite would have been going down, but we had a great CPI number and we had a Fed pause right in the middle of the week.
Yeah.
So those are reasons for the market to continue its trend. But market makers have to make a balanced market. So if everyone wants to buy, they have to be selling. And with all of these call premiums, with people buying calls as it's going up, a lot of these people might have bought calls way down here at 4,200 or even lower, maybe down here at 4,100.
Right.
Well, the market's all the way up here on options expiration. Then they might say, hey, you know what? I'm just going to exercise my options.
Right.
I'm just going to buy the stock instead. And now own this stock at 4,200, where I bought the option way back here. Now that we're at 4,450, why not own it at 4,200? Now this is the S&P, but it applies to any of the big names as well.
Yeah.
So that means that they're buying the shares that those options correspond to. And if they're buying the shares, what does the market maker have to do?
Sell. Yeah.
They have to sell shares in order to accommodate that. So that's why I said last week that we probably will see continued selling into this past week, which is what happened. Now, the other thing, if you look at this, is the market was way above its 21-day and way above its 50-day moving averages, right? So it doesn't stay there for very long.
Yeah.
So it will start to come back down anyway. So I said at the time that 4,300 would be a healthy place. Now the 21-day now is at 4,308.
Okay.
So 4,300 would be a healthy place for the market to pull back to.
Okay.
And if it does, and then starts to move higher, then that might be a good time to get in. Because I think by the end of the year, we're going to be back at all-time highs. Now, having said that, a couple of things to think about, and I talked about this in the newsletter, is what happens during this period. So this is Stock Traders Almanac. First of all, this was a really interesting one. This is Stock Traders Almanac too, but this highlights what I said, that kind of the opposite George week, the week of triple witching options expiration. They call it quad witching, but it really isn't quad anymore. It's really triple witching now. So if you look at this, this shows you the week of options expiration, and this shows you the week after options expiration. Okay. So what I highlighted were all of the weeks where the market went up during options expiration. And then what happened the week after. So look at all these ones that are circled. The market went up during options week, went down the week after. Every one of these. And you could do the same, the opposite. So the one just below this, 2 years, 21 and 22, it went down during options week, and the week after it went up. See that? The opposite.
Yep.
So that's why I was saying the market was probably going to go down.
Okay.
Because historically, that's what's happened.
Yeah. And again, folks can go back to your playlist from last week and watch you go through that in real time. I thought it was really well done.
Right. Exactly. So this is June's. This is again from Stock Traders Almanac. So they show the performance going back 21 year, and then pre-election years going back to 1950. So the dotted dash lines are pre-election years. The market typically does well in pre-election years and election years. And that's very consistent. You know, going all the way back to 1950, you can see the difference between that and just going back to 2002. And it makes sense because the party that's in power wants the economy to do well. Typically what happens is they do all the hard things during the first year of their term.
Right.
And then they start to do the easy things or start helping the economy during the year before the election and the year of the election.
Right.
Now, this time it was a little different because Biden was going through a really tough period in the beginning because of COVID.
Yep.
Right. So they had to do a lot of spending in the beginning of his term. Instead, they normally do all that spending at the end of the term. But historically, this is what it's looked like. So we are here right now. We've got 1 week left in June. You can see Monday is, historically, Monday's not a good day anyway. But in this case, Monday is also going down. And then after Monday, it goes up. This is July. So you can see July right here. In fact, July till the middle of July. This is the NASDAQ. This blue dash line is the NASDAQ for a pre-election year. So beginning of July till the middle of July. Now, typically, and this is something that I personally have noticed over the years, is the few days before the 4th of July and the week after the 4th of July is usually very bullish.
Okay.
So that kind of plays out here. This is actually showing it going further than that. So, you know, this is the July 3rd and 4th, the market's closed, Monday and Tuesday. So this is the week after right here where it's starting to go up. And this is comparing 5 years together. And this is all in the newsletter as well.
Yeah.
So this
I
is
can't believe
showing
you put
five.
all this in the newsletter. It's pretty amazing.
Yeah, this is 5 years. You can see, I think we are looking more similar to 2021 than the other
Hmm.
ones. It's the green line.
Okay.
All right, so 2021 ended up higher. But look at this. This is from Tom Bowley. This is historically, this is annualized returns
For those two, or for that day.
for these 2 days. June 26th, minus 75%. That's Monday.
Eek.
So Monday could be not a happy day.
Hmm.
And then June 27th is also down, but then June 28th and all the way through the week of 4th of July is historically bullish.
Okay.
So we might have, you know, a little rally going into mid-July.
Okay.
But then what you see here is the rest of the summer. The rest of the summer is kind of sideways, and actually might even be a little down for the rest of the summer. So I would say for those traders out there, and myself included, be prepared for Monday. It might not be a good day. If the market does rally like it normally does after the 4th of July, it might go a little bit more than that. But then be prepared for a down or sideways market through the
Summer
rest of
doldrums.
summer doldrums, right?
Okay.
Until November, you know, mid-October, that's when it starts to take off for the end of year rally, and that's when I think we're going to get back to all-time highs again.
Again, you're still calling all-time highs by the end of the year is your current best guess.
I am,
I like that.
yes,
You've been consistent. I will give you that.
and it's just a guess.
Oh, of course, it's a guess. I guess
So
all
the
the time.
other thing that I talked about in the newsletter is, and I alluded to this last week's, and I said I'll talk more next week. Said there was one thing that I was concerned about, and that was these articles that I saw last week about Janet Yellen defends the dollar.
Yep.
I actually put these links in the newsletter if anybody
Yep.
wants to read them. Secretary Yellen anticipates slow decline in dollar's reserve currency. Now, we talked about reserve currency here a few weeks ago.
Mm-hmm.
And the fact that it is the driver of the world's economy.
Mm-hmm.
Some things you have to buy in US dollars, like oil, for instance, and other things as well, because it's the reserve currency. Now, because of our economy and because of our rule of law, that's why we are a strong reserve currency, and that's not going to change anytime soon.
Right.
However, if the BRICS, for instance, or if there is any other currency in addition to our reserve currency, it doesn't have to replace the reserve currency.
Yeah. Strong alternative. Yep.
Just an alternative. So if China and Brazil and India and Russia all decide to start trading with each other using their own currencies, or using the Chinese currency as the base, that's not replacing the reserve currency, but it is an alternate reserve currency.
Sure.
Now, what that really means is, well, first of all, what the reserve currency means is if these countries want to buy oil to run their economies, they have to do it in US dollars. In order to have US dollars, they have to buy United States bonds,
Mm-hmm.
which is our debt. So all of these other countries are buying our debt, which is great if we are the reserve currency. And it means we can continue to spend money like it's, you know, like it's water.
Going out of style. Yeah.
Because all of these other countries have to continue to buy our debt, because that's the only way that they can buy the things that they need to buy, because we are the reserve currency. If there is an alternative to that, the first thing that it means is they no longer have to buy as many dollars as before. Right. They still have to buy them, but they don't have to buy as many.
Right.
So what will that do? That will probably affect the dollar. It may affect inflation
Maybe
in a way that we have not seen probably since the 80s, and maybe not ever, because the inflation that occurred after COVID was a supply-demand inflation.
Correct.
If this happens and we have to print money in order to service our interests for our debt, then it will be true inflation based on additional dollars in the system.
Yeah, dollar devaluation. Yep.
The dollar devaluation. So there's been a lot of talk about that in the media as well, about the death of the dollar. So just like I did last week, I always like to put these things in perspective. Is the dollar really dying? So here's the dollar going back to 1990. This is a 33-year chart of the dollar.
Yep.
So you can see the huge run-up that it had after COVID. In fact, it's the second highest point that the dollar has ever been at after 2000.
Yep.
And then the dollar started falling, so everyone's, screaming the sky is falling. But I put this chart into quadrants so that you can see where the midpoint of this 33-year cycle is.
Oh, that's helpful.
And we are still above the midpoint. So the dollar, the dollar is still safe. The dollar is still healthy. It's not going anywhere. In fact, the low point was in 2008.
Yep.
When the dollar hit way down here, but we are not even back to the midpoint just yet.
Okay.
So all of this talk, what Janet Yellen's talking about the reserve currency, about the BRICS nations, about the dollar getting weaker, all of that talk is not necessarily incorrect, but it will take quite a while to play out.
Agreed.
And I have always said that, we're in a secular bull market, and that secular bull market should last until 2029 or 2030, somewhere in that area. 2029 just coincidentally happens to be the 100-year anniversary of the 1929 crash that kicked off the Great Depression.
Yep.
That's 6 years from now. And 6 years is certainly plenty of time for all of this reserve currency talk to play out.
Okay.
But for now, we are still in a secular bull market, and we are still heading higher.
There you go. Very, very good, Dan. Well, why don't you do me a favor and show your newsletter one more time? Where can people get it? And we will have a hot topic number 2 coming up next.
Yes. If you're interested, send me an email to breakpointtrading@gmail.com, and I will add you to the list. And I will just mention to anyone that's listening, because I had a few emails last week from people that signed up and then thinking that maybe I didn't get their email, and they sent it out again and asking me to sign up again. And when that happens, I usually go and look to see if they are already on the list. And in most cases, they are. And the email ended up in their spam folder. So if you send me an email asking to join, I usually will get that on within a couple of hours of you sending it. And I will send you last week's newsletter right away. So you should expect to see last week's within a few hours of you requesting it. If you don't see it within a day, go look at your spam folder and see if it's there. And if you still don't see it, then send me a note and we'll figure out what happened.
Very cool, Dan. Well, again, breakpointtrading@gmail.com. It's something I read and look at every week. Thanks, buddy.
You bet.